Thank you, Steve. Good to make your acquaintance. And just thanks to Karine, because she is my, I guess, my access to start talking with Yvonne and then get this scheduled. Anyway, I've been in the business for 31 years. I started in the mortgage business in 1989 full time and been doing it ever since. And I'm waiting for the gold watch and the golden parachute. I don't know that comes automatically. I think you have to earn it in our business, but I have done a handful of transactions with Presidio agents, and this is I consider it a good privilege to be here with everybody today, because I know that you guys run a very professional shop, and if everybody over there is as close to a detailed and professional person as Karine is, then I'm in good company. So appreciate the opportunity to chat for just a few minutes. But you know, over the course of my career, I've also, I want to say, dabbled as a real estate investor. I mean, done a little bit of this, a little bit of that, picked up some rental properties, done some land and whatnot. And last year, it was actually, I was at a Christmas party that was kind of a mastermind thing. And I was talking with another friend of mine that's a lot more of a real estate investor than I am. And he was telling me about this great deal that his CPA had introduced him to, and he was saying, he says, "Oh yeah," he says, I made a ton of money last year, and I'm not going to have to pay any taxes on any of it." And I was like, well, you know, perked up, and I go, "Okay, tell me what you're doing." And anyway, he introduced me to a company out of Phoenix. They have an office in Provo, and I've shared some information, but this is not something that I would just, you know, share the information with and saying this would be a good idea. I've actually done this. I bought a couple of rental properties last year, and let me just ask, just for collectively us in the real estate business and for our clients, what is probably, and just open up your mics, but what do you think is probably the biggest impediment to getting good financing terms on investment property in this market? What's the biggest obstacle? Anybody want to share a thought on that?
20% down, it seems to be for a lot of people.
Yeah, and the 20% down is the minimum, and the interest rate, if you can put down 25%, the interest rate gets about 3/8% better. So there's a sweet spot in there that I'm putting down 25%, but you know, you're looking at properties that probably start at 300,000, maybe to 400,000 for investment property. You're starting to talk upwards of $100,000 for a down payment, and that's not chump change. And for a lot of people, that might be most of what their nest egg would be, and then to put it into an investment property to get good terms, you know, it's not real enticing. But I shared some information, and I know that Chelsea's got the documentation on it, and we don't need to bring it all up right now. So I'm just going to give just basically how it works, but there's some IRS code stuff, there's some tax planning stuff, there's some depreciation stuff. There's a lot of things that have happened just within the last administration here that make real estate investing a lot more enticing. So there was the Tax Cuts and Jobs Act that was passed back in 2017. And what they did is they changed the depreciation schedules. In other words, how you can depreciate rental property. It always used to be, you know, decades ago, I mean, and for a long time, it was basically the straight line 27 and a half years, depreciate the property down to zero. And then when you sell it, you got to recapture it, plus your capital gains, and you're stuck kind of doing a 1031 and all this other stuff. But the Tax Cuts and Jobs Act put in something that's called, it is called the Modified Accelerated Cost Recovery System. Now, I don't know all the terms in the tax code, but I know what it did for me, and I've shared it with some of my clients. And I'll explain a transaction that Karine and I are actually working on together that ties in exactly with this, this new tax law that's out there. But this applies to properties, investment properties that would have been purchased after September 29th of 2017, but it sunsets, and it doesn't like turn off on the light switch, but it starts fading away quite quickly on properties purchased after December 31st of 2022. So there is, as of today, there's about a 2.5-year window that you can take advantage of this. And the functionality of it is this, that if you buy a property for an investment property for say $300,000 and you put down 25%, you put down 75 grand. This new depreciation schedule that you can put in there. Now you have to pay for a report. You've got to have a bunch of information in there, but you get the report, turn it over to your CPA. The numbers from that report populate into a Schedule E for a rental property, and you basically get to depreciate 25% of the purchase price in the year that you acquired the property. And the example, and Chelsea, maybe you can pull up the one that's like the chart, that's kind of got the chart and the table on it. If you could pull that up onto the screen, because I tried to do it from here and it kicked me out of Zoom. So I'm not going to attempt to try that again. But this was a property that I purchased in Eagle Mountain actually, I bought it on December 4th of 2019 last year. And the purchase price, I think, was $330 or something like that. Anyway, I put down, I'm sorry, I can't remember, it was less than that. 311, something like that. But I've got a great tenant in there. It's going to be a great property. Oops, what did I just do here? Okay. But the amount of depreciation that I was able to take after owning this property for 27 days last year was this top line over here of $76,317. I was able to take that as a depreciation charge on my taxes. Now, I want to just point out that this is different than writing it off. I mean, if this is expenses and you're self-employed, everybody says, okay, well, that's great, but now I can't qualify for a loan because I just wrote off $75,000 or $76,000. Depreciation is a book charge. It's not an actual expense. So it gets added back into the income calculation if somebody's trying to buy property. And I bought 2 of them last year. So I had over $130,000 of depreciation that I was able to take against my taxes last year. And it was huge. I mean, as far as the amount of tax savings that was for me personally, that was a huge thing. So here's where I think that this works really well for some people is that, if you have some double income families out there, I mean, it's not tough, to find a lot of people out there that have a 6-figure household income. A lot of those people also have 6-figure retirement plan, 401k, they've got something in there. And this would be good on just its merits alone, because if somebody was going to go and put that down payment down, the leverage that you get off of that to be able to take that depreciation charge, this is pretty significant. Now, you are exchanging that and you're going to have some reduced depreciation for years 2 through 15 after that. But just imagine if you're sitting there coming up with whatever you got to do to come up with your 25% down, if you know that money that you're putting down is basically going to be a tax deduction, how does that change your rate of return, your internal rate of return, your return on investment, whatever kind of metrics you want to start plugging into an investment property? Take a look at it if you can write off your down payment on a 25% down payment. Anybody get some ideas? Does that start flashing a couple of flashbangs in the head that maybe, wow, this would be a good time for maybe me personally, or I've got some of my sphere of influence people that this might be a great opportunity for them to pick up, depreciate, or an investment property. The other thing that coincides with this is that because of COVID-19, and Chelsea, if you want to bring up the next one, this is just the IRS tax code, and I don't want to get into the weeds of this, but this has now been clarified and codified, and this is going to go on for, I think, this basically until the end of the year. But most people that would have 6 figures available, that would have $100,000, they don't have it sitting in a checking account, okay? Most people, where's that money going to be? 401ks, IRAs, right? And the impediment there is that it's the penalties and the taxes associated with bringing it out of there. Well, the IRS has made some changes on that. And again, I just want to be really careful. Talk with your CPA. I mean, because this is not carte blanche and it works the same way for every single person. Everybody's got different circumstances and whatnot. But the ability to go in there and to maybe tap your 401k to use some of that money without the penalties and convert it. And even if you had it, even if the withdrawal ends up becoming a taxable event, taking that money out where you can now take out up to $100,000, to be able to depreciate that and have it as an offset on that, it kind of takes the sting away from it. But the thing that's nice about this is that, and I talked with my CPA who, he hadn't seen this before. It was new to him, but then he went and looked at the report, figured everything out. And then when he worked up my taxes, I mean, it was a very pleasant surprise. But he informed me that if you don't need all of the deduction, maybe you sit and after you've done your taxes and you put $100,000 down and you could take a $100,000 depreciation charge against your taxes. You say, well, geez, you know what? My tax bill is going to be just fine if I only took half of it. You can roll the other 50,000 into the next year. In other words, you created basically a depreciation bank, if you will. So this is just something I think that if people understood the tax advantages that would come to them for picking up investment property, I mean, I'm very confident that the rental property price range, you know, I mean, you know, starter home, I mean, good grief, you know, what do we, I mean, I bought a duplex in 1992 for $50,000 in West Valley City, and I thought I spent a lot of money to pick that up. And now we're looking at a cheap and inexpensive rental property is $300,000. But there are, I just think that we're going to have a strong housing market in Utah for a long time to come. I think that we're going to have a net influx of people, and I think there's going to be a shortage of housing. And if the rents are going sky high, and for somebody to sit there and look at the numbers on this, to be able to get the tax advantage, to be able to get a rental property that you have great financing terms, a great equity position, and have this bonus depreciation in there, I think this is a game changer for a lot of people, and I think you guys should let your sphere of influence know about it. Any questions? Open any other. Can we get these slides sent to us? Sure. I've actually got the full report and some other stuff too, if anybody wants that. So I've got it's about a 26-page report per property. And I had to spend $2,000 per property to get the report, but the benefit way out was much more advantage to the cost than the cost of it. So it was worth it.
George, I've got a quick question for you.
Yeah.
So I have an investor I'm working with, and he is going to be doing a loan through Mountain America Credit Union, who they have a 10% down investor program.
Yeah, they do.
So he's wanting to do that. So would this same scheme work for 10% down as it does for 25?
He can write off the 25. He'll still get a 25% depreciation with 10% down. Yeah.
That's going to be really good information for me to send him today.
Yeah, right. Yeah. So yeah, they do. So yeah, you can do that. But it's, yeah, so no, it doesn't matter what your acquisition, how much you put down. I mean, it's just based on the acquisition cost. It works out to about 25% of the acquisition cost that ends up being written off. And so technically, if somebody bought a home if they bought it with seller financing and put down 10 grand on a $500,000 home, they're probably going to get up to a $125,000 depreciation charge off of $10,000 coming out of their pocket. But I'm just kind of using the example on there for Fannie Mae, Freddie Mac conventional stuff on that. So yeah, good question. And so anybody that's sending a chat that says, send the info to me, Yvonne, I guess you could just, could I send it to you and then just have you distribute it then? Would that be the best thing?
Does everybody want it? If you do, I have a list of everybody that's attended. And if you'll send it to me, I can send that list out to everybody else. The only person on here, I have a Robert and I have no clue. We have a couple of Robertses. So what's your last name, Robert?
If you just get it to Lisa Dedman, then I'll get it.
Ah, it's
Okay,
the husband. Yeah.
all right.
I'm
you.
her analyst, so that's why I want it.
Yeah.
You know what? That's good to know because I track the people for the awards of the persons attending the most classes, and I didn't know who to give credit to. So thank you.
But anyway, so there's about a 2.5-year clock that's ticking on this, and then it starts fading away. The amount that you can take off that first year starts dropping off pretty precipitously. So it's just fun. I think there's a lot of people out there that are a little gun shy about getting into investment property or something like this. This makes it, I think, pretty advantageous. So.
Okay, I've got another follow-up question. All right, so I actually am also buying investment property this year. And what if I don't, who knows what our tax burden will be, but is this roll for like 3 or 4 years if we don't need it all in the first 2?
I don't know how many years you can carry it forward.
Okay.
Yeah, so that's a good question. And what I know is that you can't write off so much that you actually get, you can't get more money back than what you've paid in taxes, but you can zero out your taxes. So if somebody that had an opportunity that picked up, had a windfall and picked up 2 or 3 properties or something like that and only needed to depreciate 1, I mean, you probably can position yourself to not pay income taxes for a few years going forward. And that's, I mean, I had somebody tell me one time, the best rate of return you can get on your money is good tax planning and reduce your taxes. So.
All right, thanks.
It says there's 33 people. Oh, there's 20 participants out there and 33 chats. Okay.
Hey, Tressa, where did you say you're getting the 10% loan from?
Kim, that's Mountain America Credit Union has an in-house loan. We've done it ourselves for one of our investment properties. This year, we're doing a 25% down traditional. But Mountain America, it's a 10% down. It's a 15-year balloon. There's no mortgage insurance, and it's set on a 30-year amortization, but there's a 15-year balloon.
Okay. All right. Thank you.
Hey, Teresa, do you know what the minimum FICO score needs to be on that?
I don't.
George, wouldn't it be maybe 640 on your mid-range?
That's a good question. I don't know. If it's an in-house product, they're probably a little, I don't know. That's a good question. I have another friend that I work with that he's picked up a few properties on that one. And then he, but then he wasn't able to. He got, I think he might have tapped it out. I think he did maybe about a half a dozen with them. I don't know if they have a limit on number of properties that they'll do, but he had tapped it out and then was going some other places. But you're tapped out. Fannie Mae and Freddie Mac are going to limit you to a total of 10 financed properties anyway. Your primary residence, you can have 9 others. So yeah, everybody runs into a limit. There's some of the non-QM stuff that's out there for investment properties that does not have as good of terms, but you're getting even 1 or 1.5% better on the rate. It changes your cash flow position so much on an investment property that, it's best to just try to get that payment as low as possible so that you can have a good cash flow position. And if you can do it with less money down or depreciate your down payment, then it just makes it a lot easier for people.
Yeah, I believe the Mountain America Credit Union one, they kind of have it positioned primarily for existing, or you've already been an investor. This is not your first rodeo, basically. They want to, so it worked well for us. We did one last year with it, and they do have a limit on how many they will do. You do still get a good interest rate. We got, I think, 3.5% or something crazy. So, I mean, as an investment with 10% down and no PMI. So
Yeah.
it's good. It's a good option, but you may need to already have had at least one investment property. I'm not entirely sure.
And the other thing I know on this too, when you go in on this, I would not have anybody do this and assume that you're going to be eligible to write off 100% of what the potential depreciation is. This is really something you got to sit down. I mean, I've had the same CPA for 25 years, and I just thought he was a genius and knew everything. And then when I sent him these reports in advance, I said, "Hey, Eric, is this something that, I mean, can I use this?" He goes, "I've never seen that." And I was like, so and stuff. But I think once they've seen it once or twice and done it, but I would definitely consult with a tax advisor. So that's my disclaimer.
Any other questions for George? George, that's great info. George, tell us what company you're with and how, and all your contact information.
Yeah, I'm with branch manager for American Pacific Mortgage. I had my own brokerage for about 22 years, and then we just kind of went underneath their umbrella. So still doing business as Mortgage Financial Group since 1998, but we just really get I have great relationships with my underwriters, and Carrie knows that I have a kind of a knack for taking on transactions that have a little bit of hair on them, and having a relationship with an underwriter is all the difference in that. But I have a website. It's thecreditjungle.com, and then my email is george@thecreditjungle.com. But yeah, and Carrie's got that in her. But that's
Cool.
me. And like I say, I've got a property that Karine helped me buy. I picked up an investment property in 2016 in Murray, and we're just in the process of fixing that one up. And the whole reason I'm selling that one is so that I can use my proceeds from that to go and buy another one and not do a 1031 exchange, just so that I can take advantage of the depreciation the bonus depreciation I can take on the next one, because this one I bought too long ago to be eligible for it. So even somebody who's thinking of doing a 1031 or has a rental and maybe wants to get rid of one and trade it for another one, this is a great way to do it without all the 1031 limitations on your timing and all the other stuff that you have to do on it, and still get the benefits of a 1031 without having to pay the facilitator and then be under all the time constraints. But anyway, thanks, Steve.
Okay, Karine, I want you to say something else about George that we don't know.
Careful.
He's available 24/7 almost. I mean, this man has an office in Sandy, but he lives down in San Pete County, and he travels up to his office 2 or 3 times a week.
Yep.
But even if he's not in his office, he's working from home and he's available. I'm going to tell you guys a real quick personal. Most of you know, or many of you know, that my sister was my loan officer, my preferred lender, for about 15 years. And she passed away of ovarian cancer about 3 years ago. And it was, nobody in my mind could measure up to how Leanna treated my clients and how well she and I worked together. And I went through a handful of lenders that I felt like they needed a personal touch with my clients. I had gone through George a couple of times because I had a buyer that was already pre-qualified with him. And he's every bit as good as Leanna. So for me, it's a very personal thing. I love the way he treats my clients, and I love his availability. And I mean, it just goes to say he's brilliant. So there you go.
Cool, thank you. And in chat, I saw Karine put his contact information and stuff. So George, we really appreciate you being here today. We appreciate your good, valuable information that helps us know stuff that we didn't know before. So
My pleasure. Hopefully it allows you to go and shake a few trees and get a few more deals in. So
sounds good.
all right.
Or
Thanks,
buy
Kate.
his property next week when we put it on the market.
Yeah.
There
Yeah.
you go.
All right. Thanks.
All right. Anybody have anything else? We're a little bit early today. Anything you want to talk about, bring up? No? Okay. Well,
Great
then we'll
job,
just
Steve.
sign off early today. Everybody have a great day. Enjoy the weather. It's supposed to be a good day, good weekend. Happy 4th of July. Probably might not talk to you or see you until next week. So appreciate you all being on board and supporting the program. And again, congratulations to those winners that support our education and everything that we do, trying to raise the bar for our company. So you all have a great day.
Steve?
Yeah. Yeah.
I think Chelsea sent out a notice that the office will be closed on Friday, just as an FYI.
Yeah, we are closed on Friday. It's a national holiday. So
Okay. Thanks,
it's still
George.
recognized. Okay, guys, thanks.